Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, my name is Ravi Singh. We've just released our second half 2023 India Market Outlook titled Keep Calm and Carry On. In today's podcast, we summarize our views on equities and our sector strategy. After a weak start to the year and trailing global peers for most part of first quarter, Indian equities staged a strong recovery in second quarter of 2023, scaling new all-time peaks with the breadth of the rally improving and broader markets outperforming the large cap peers. Against this context, it is tempting to dial up risk and start chasing equity rally. However, we have a neutral stance on Indian equities as above average valuation premiums, both absolute and relative to peers, is counterbalanced by strong domestic growth, resilient earnings growth expectations, and robust fund inflows. In our view, Indian equities continue to be supported by strong positive drivers. 1. GDP growth and earnings outlook remains robust and continues to outpace its major peers. Second, the recent underperformance of Indian equities relative to peers amid strong earnings delivery has turned valuations more reasonable. Third, stable inflows from domestic investors driven by inflows into systematic investment plans is a key support for the market. And finally, pace of foreign investor inflows have improved amid reasonable valuations, robust fundamentals, and low foreign investor positioning in Indian equities. Within equities, we upgrade mid-cap and small-cap equities to overweight, given broadening growth momentum, improving earning outlook, and a likely peak in bond yields. We have a preference for value-style equities. Having said this, we remain mindful of the risk to our positive views on equities, which include global growth slowdown and probable downgrades of earnings expectations, above average equity valuations both absolute and relative to peers, and third, foreign investor selling amid slowing domestic investor inflows. Coming to our sector strategy, overall, we prefer a barbell sector strategy to manage volatility in the current context. Accordingly, we are overweight domestic cyclicals given resilient domestic growth, favorable earnings expectations, and relatively better valuations. We have upgraded healthcare to overweight given its defensive nature and improving earnings outlook. Financials is a key overweight sector for us. Robust domestic economic growth has driven a broad-based uptick in credit growth. Healthier corporate balance sheets, robust loan growth is likely to offset margin compression due to rising funding costs. Further, healthy asset class outlook driven by a moderation in slippages, healthy contingency buffers driving a moderation in core credit costs are also likely to support the sector's profitability. Earnings expectations for the sector remains robust, with ahead of market EPS growth of 16% and 19% for fiscal year 2024 and 2025 respectively. The sector is trading at a 12-month forward price to earnings of 18.4x, lower than the market valuation of 21.9x for MSCI India. Industrials is the second overweight sector for us. The sector benefits from a multi-year investment-led economic growth cycle, with earnings growth for fiscal year 2024 and 2025 at 46% and 24% respectively, which remains higher than most sectors. The government's continued focus on capital expenditure, coupled with providing incentives to boost manufacturing and infrastructure spending, is a strong structural driver for the sector. Further, continued public capex outlay, strong order book, lower commodity prices, and nascent signs of a revival in private capex are additional tailwinds for the sector. Healthcare remains the third overweight sector, which we've upgraded recently. We prefer the sector for its defensive nature, providing us a potential hedge against uncertain global macro backdrop, and are overweight in domestic cyclicals. The sector has underperformed since 2022 on COVID-era expensive valuation multiples and muted earnings performance, albeit on a high base. The earnings outlook for the sector has stabilized due to the following reasons. First, stable performance in domestic formulations. Lower price erosion in US generic segment. Third, reversal in raw material and freight costs. Though the sector trades expensive compared to its long period average, with the current 12-month forward price to earnings at 29.8x compared to 24x its 15-year average, This is lower than the 36 times it was trading at the peak of 2020. That's it in this edition of the podcast. Do reach out to your relationship manager for a copy of a market outlook. Thank you for listening, and if you enjoyed this podcast, please like and subscribe. Have a great day ahead.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered Relationship Manager or visit www.se.com/in.